All right, let's just dive right into this explainer. Look, if you've been anywhere near financial news, your social feed, or, a mildly argumentative family dinner lately, you've definitely heard the ultimate question, is Bitcoin going to zero? But here is this fascinating secret that nobody tells you. Zero is actually a comforting trap. Seriously, it's a comfortable question, it has a comfortable answer, and honestly, both the bulls holding on for dear life and the bears predicting total doom just want you to keep asking it. Why? Well, because as long as we're all arguing about some apocalyptic absolute zero, we're completely ignoring the actual mechanical realities of what's happening to the market right now. So today, we're blowing past all that emotion and the noise. We're going to look strictly at the hard data to uncover the real structural mechanics driving this asset.
Now, what's really interesting about this exact quote is who actually said it. Peter Schiff. The guy is arguably the most committed vocal Bitcoin bear alive today. I mean, he has publicly declared the asset dead 22 separate times since it cost literally 11 cents. And yet, when handed a completely clean opportunity earlier this year to predict that the price will hit absolute zero, he totally declined. Instead, he predicted a 99% loss, but explicitly noted it would survive above zero. Think about that. Even the fiercest critics aren't actually arguing for zero anymore. They're arguing for something functionally worse and rhetorically a lot weaker. An asset that just lives forever, maintains its network, but simply never pays you back inside your investing lifetime.
To understand why this distinction matters so much, we have to look at how prices are actually moving today. Between late 2023 and the middle of this year, Bitcoin suffered roughly a 48% drawdown. That is half your money just gone in 9 months. But we have to recognize that this wasn't a violent crash. In the past, Bitcoin has dropped 77, even 93%. Those were crashes. They were super fast, they produced extreme panic, and as we know, panic produces a market bottom. But what we're experiencing now, it's not a sudden crash. Actually, it's more like a grueling staircase pattern. It's this grinding step down, a pause, another step down, just dragging out over 9 months. And a staircase doesn't produce panic, it produces exhaustion. It creates this very specific late-night feeling for everyday retail investors. Take a woman we'll call Lindsay, working in Sacramento, currently sitting 43% underwater on her investment. At a certain point, you stop being scared, and you just start feeling embarrassed.
And the data beautifully illustrates exactly why the market dynamic has completely changed. For 15 years, price was totally dictated by human emotion. Chaotic, unpredictable individuals deciding to buy or sell on a whim. But then, Wall Street arrived. The exchange-traded funds, the ETFs, got approved. We were all told institutional money would bring stability, right? They'd be the adults in the room. Well, institutional money didn't bring stability, it brought plumbing. It's a massive pipeline now, with research estimating that ETF flows dictate roughly 45% of weekly price movements. And here's the thing, plumbing doesn't have conviction. Plumbing doesn't care about the future of finance. Plumbing just has a cold, mechanical redemption schedule.
So this brings us to a massive shift in the whole ecosystem. Institutional adoption essentially replaced the emotional panic seller with cold, mechanical, structural sellers, entities that dump assets on a rigid schedule, completely regardless of market sentiment. We're talking about the big three. First, the ETFs we just talked about, which automatically sell when investors pull their funds. Second, the miners who actually process the network transactions, they have massive real-world operating costs. And third, corporate treasuries. These are companies holding billions in Bitcoin on their balance sheets, but they have to manage traditional corporate cash reserves and, shareholder expectations. And the kicker? All three of these massive entities became net sellers in the exact same 6-month window this year. 32,000. Let's zoom in on the miners for a second, because this massive number represents the record amount of Bitcoin sold by public miners in a single quarter earlier this year. To put that in perspective, it beat everything they sold in all of the previous year combined. And why? Well, it's because of operators like Dale, a guy running mining rigs out of a converted horse trailer in western Kentucky. See, Dale doesn't care about global monetary policy or Twitter debates. Dale has to do the math on a massive electricity bill. When the price falls, but his power bill stays exactly the same, or even goes up because it's a freezing January, he has to sell his newly mined coins just to keep the lights on. He is a forced seller. And then you've got the corporate treasuries, and they are driven by a metric called MNAV, or Market Net Asset Value. This calculation happens when the stock market basically decides a company is somehow worth less than the giant pile of Bitcoin sitting inside its own corporate vault. And this metric forces companies into a ruthless, spreadsheet-driven loop. When their stock price falls, the premium they use to borrow money just disappears. So to pay their standard corporate obligations, like preferred stock dividends, they're forced to sell some of their Bitcoin. But selling those coins pushes the broader market price down, which then makes their M&AV premium even worse. It's wild. It's not a conspiracy, it's literally just a spreadsheet executing its programming.
Okay, but to be completely fair to the ecosystem, we absolutely have to flip the script and look at the bull case, because honestly, it's incredibly compelling. Remember those obituaries we talked about? Someone actually built a website tracking them. There are currently 475 published articles from economists and public figures definitively declaring Bitcoin dead. Now, if you had invested a mere $100 every single time one of those experts published an obituary, starting back in 2010, you'd have put in about 47 grand total. And today, that stash would be worth roughly $67 million. It's crazy, but ignoring economists has historically been the single most effective Bitcoin investment strategy ever devised.
The bulls are also supported by this powerful mathematical reality happening right under the surface. Coins are literally disappearing from circulation way faster than miners can create new ones. Fidelity researchers found that hundreds of coins a day are aging into a category they call ancient, meaning they haven't moved in a decade. Millions of coins are permanently lost by everyday people. Take an investor named Hollis, for example. Back in 2014, Hollis bought $500 worth of Bitcoin entirely out of pure pressure at a lunch table and promptly forgot his password. He hasn't been able to touch it since. Hollis and millions like him are accidentally propping up the entire scarcity argument of the network by simply misplacing their keys.
However, Federal Reserve survey data grounds this whole narrative beautifully. When you look at the numbers, the most typical American holding is just between $100 and $1,000. If you spend time online, you'd think everyone's a crypto millionaire. But the average gets dragged way up mathematically by a very small number of enormous whale wallets. The typical everyday user holds an amount that's way too small to actually change their life, but just large enough that they'd be really annoyed to lose it. It's money put in simply out of FOMO, the fear of missing out, because the alternative was sitting on the sidelines watching everyone else supposedly get rich.
And for those average buyers, the math right now is just brutal, because they bought during dense accumulation zones, which is basically when the hype was highest and prices were peaking. Short-term holders are deeply in the red. Let's bring back Lindsay, our investor from Sacramento. She bought at the height of the frenzy. At today's prices, she isn't just a little down. Because of how percentages work, she now needs a staggering 76% gain on the current price just to break even. Think about that. She needs a massive, face-melting bull run not to get rich, but literally just to get back to zero, to be exactly where she started. So if we look past the daily price charts for a minute, what are the true existential threats to this network? Like the things nobody puts on a clickbait thumbnail. Well, it starts with the very code itself. Think of Dale the miner acting as a bouncer for a $1 trillion nightclub. He gets paid a guaranteed salary by the club to secure the doors. But written directly into his contract is a crazy rule. Every 4 years, his salary is slashed in half. This is the famous Bitcoin halving. Meanwhile, the club gets bigger and the patrons get richer. Fast forward a decade, and Dale is guarding a multi-trillion-dollar network for a fraction of what he makes today. Eventually, either the price of the asset has to absolutely skyrocket to compensate him, or the whole security model of the network gets tested in ways we've literally never seen before.
And if that wasn't enough to chew on, the looming threat of quantum computing has officially stepped out of science fiction and straight into the code. Looking at the aggressive estimates, experts calculate that the network's encryption could be cracked in as little as 5 to 7 years. Even the really conservative estimates place it at 20 to 40 years. This isn't just some theoretical debate in a university anymore. Developers are actively rushing to propose quantum-resistant defenses right now, today.
And here's the thing, the proposed solution for this quantum threat is wild. A recent code proposal suggests that to protect the network from being entirely looted by quantum computers, developers might have to migrate secure wallets and potentially permanently freeze the vulnerable ones. The impact of this is staggering. To execute this migration, we're talking about freezing up to a third of all circulating coins. That includes the legendary stash of an estimated 1.7 million coins belonging to the anonymous creator Satoshi Nakamoto. So to protect the money that supposedly cannot be confiscated by governments, the network itself might have to effectively confiscate a third of its own supply. It's mind-blowing.
So the absolutely crucial point we're arriving at here is that zero is essentially off the table. The network is fundamentally too robust, the computing power is at record highs, and those millions of permanently lost coins create a hard price floor. But surviving is not the same as thriving. The real risk is an asset that survives indefinitely but never pays you back. which is exactly why before you put a single dollar into this ecosystem, you have to answer these 3 specific questions. Number 1, who is the marginal buyer after you? Number 2, what specifically and numerically needs to happen for your portfolio to actually grow? And 3, what does mere survival get you if you're trapped breaking even for a decade?
Which brings us to the ultimate takeaway from today's explainer. Can you answer these 3 questions out loud to someone who actively disagrees with you without flinching? If you can honestly do that, you've got a solid thesis, and you don't need me or anyone else to tell you what to do with your money. But if you can't, I really want you to remember that simply choosing to sit out is a perfectly valid position. It has its own risk profile, its own peace of mind, and best of all, it doesn't require you to bet on the timeline of quantum computers or the electricity bill of a miner in Kentucky. The choice is yours, and now you know the actual mechanics behind it. So, are you ready to place your bet? Or is the smartest move not to play at all?